So at the year end, Southwest accrue interest expense and interest payable for 6 months, July to December, right? So the previous slide example would be for July. So the payments are, in our previous example, we saw that the payments are in July and January 1st. So balance sheet are made at the end of the fiscal year, which is 31st of December. It means we cannot pay before this January 1st. We have to pay at December 31st. So that's why here December 31st. It means we have to create liability. So this next 6 months, 2250 is not going to be paid, so we create liability. But expense occurred, right? Recall our expense recognition, right? So expense going to be recorded that belongs to for like that period, right? So expense belong to this fiscal year, right? So this fiscal year expense is going to be recorded in this year. So the entry would be interest expense to interest payable, and next year the entry would be reverse when we pay back. So we decrease our liability and we decrease our cash as well. So on January 1st when you pay back, right, on January 1st when you pay back, the previous entry gonna be where you have to decrease the liability. So you say that interest payable to cash, right? So that is how we treat our bond payable, which is issued at par. About the after 5 years when they pay off the bond, which means to pay the bond in 2019 issued in 2014. So now 5 years have passed. What would be the entry? And entry would be that bonds payable to cash 50,000. That's it, right? The simple entry. That's it. The logic is that we are having the bond payable at par. In during this 5 years, interest rate, stated interest rate, which is coupon, is equal to market rate, right? Now let's go towards a more real example. That is because during the life of the bond, the market rate changes. It is subjected up and down according to market conditions. So let's talk about that. So we have new example of Southwest Airlines, so which issued $100,000 worth of bonds at 9%, 5-year maturity value, when the market rate is 10%, right? So just pause the video and try to understand that whether this is a case of discount or the premium, right? So think about that. The market rate is greater than coupon rate, which means the demand for Southwest airline bond gonna be decreased. So that's why they issued at 1,000 but they received 96,149. Understand? But at the end they have to pay back this 100,000, right? So we create liability exactly this 100,000 because we have to pay back $100,000 at the end of 5 years. No matter how much we receive now, it doesn't matter. But after 5 years, we have to pay the face value 100,000, right? So it means entry would be that we receive cash and we allow discount. Discount is minus 100,000, right? And then bonds payable. The entry would be cash 96,149. You receive that, and then discount on payable bond. This is the difference between amount received and the face value. And but we create liability according to what we will pay back in future, which is maturity value 1,000, right? Here we go. So the equation shows that the net liability is going to be this 96,149. Why? Because we receive cash, right? And expense is the discount is 381 and liability is this one, so our accounting equation is also balanced. So this is the proof, and this proof can also be from our previous slide, in which the entry is also equal, credit balance is equal to debit balance, right? How this bond payable is shown in the balance sheet. It is shown in long-term liabilities, and you write it down as you issued bond at discount, the value of the bond minus the discount, and here you write the full value, right? So what is the treatment of this discount, we'll talk about in our coming slide. So when the bond is issued at par, the interest expense is equal to interest payment. Why? Because market rate is equal to coupon rate. But in the case of discount, these two are not equal. Why? Because the value of the bond is different than the face value, right? So interest expense, it is calculated based on market rate, and in interest payments, because payments are based on coupon rate, right? Whatever is written on the face of the bond, company is liable to pay that, right? So payments are based on coupon rate, right? So interest paid semi-annually, right, which is July 1st and January 1st, right? So what will be the first 6 months interest expense? Interest expense is equal to market price multiplied by market rate. The market rate is 10%, multiplied by 10%, multiplied by 6 by 12, right? And here the interest payments are based on coupon rate. It would be, so we multiply this with 100,000, right? The answer would be here 4500. 4500 divided by 2, yes, not 4500, it would be, yeah, 4500. So 9000 divided by 2 is 4500, and this we have already solved it here, right? Let me just remove it here to make it more clear, right? So interest payments are based on face value and coupon, while the interest expense is based on the market value and market rate, right? So what did you see here, the difference? So who is more higher, interest expense or interest payments, right? So here is the tagline. So when the bonds are issued at discount, the interest expense is greater than interest payment, right? So interest expense is the item of income statement, right? So this will go to income statement, right? So basically, why it is higher? Because there is 3851 discount as well, right? So basically what we are trying to do, we are also writing off our discount with interest expense as well. So we pay 4500 interest plus some part of discount, because this discount is also for 5 years. We call our discussion of capital expenditure and simply expense, right? So this discount is for 5 years, and so part of this discount is we are going to retire after, like, every year, one by on yearly basis, right? So that's why we add some part of discount here. That's why the interest expense is higher than interest payments. So here we go. So this is the bond amortization schedule, and how it is made of. Simply, interest payments. Interest payments are based on, and why this is 4.5? Because 9 divided by 2 is 4.5. So if you see that this is 1 year, and in 1 year there are going to be two periods: January, July, January, July, January, July, January, July, right? So that's why if you add these periods to total years, here they are 5, right? So this is period 0. So we issued the bond, right? But we receive value 96,149, right? And this is the discount, right? So these are the interest payment. Interest payments are based on principal. Principal is 100,000. So that's why this is 4,500, 4,500, 4,500. And interest payment is based on the value of the bond. So here is a trick where this interest expense, you see interest expense are not equal on every period, right? Why? Because it depends on the value of the bond, right? So did you notice something? That the value of the bond approaches to the maturity value, right? Why? Because at the end of the year you are not liable to pay this value, you are liable to pay 100,000. So that's why the bond is increasing, right? So this column B, this is the interest payments. Interest payments are based on the coupon and the face value, right? This is 4,500. While the column C is, it belongs to interest expense. Interest expense calculated on the value of the bond multiplied by the interest rate. Where this 5 came from? 10% divided by 2, because it's semi-annually. Just 2 time payments in a year, right? So that's why this precedes this 4,807 came from here. And where this 4,823 came from? It came from by multiplying 96,456 multiplied by 5%, right? Here. Understand? So the discount amortized, which means how much discount is decreased with the first payment. So it is the difference between interest payment and interest expense, right? And this would be added in the value of the bond. You see, it is not decreased, rather it is increased, right? So what is the tagline here? When the bonds are issued at discount, then then the bond value plus discount start approaching to face value and exactly equal to face value at maturity. So at 5 years, this value will become the bond value or the face value or the maturity value, right? Whatever you call, between these three words: bond value, maturity value, face value. Okay.